Hello everyone and welcome. Today we are diving into a dramatic and cautionary tale about the former king of vaccines, Sinovac Biotech Ltd, SVA0. This is a company that once stood at the absolute peak of global public health. Thanks to its COVID-19 vaccine, Sinovac supplied over 2.8 billion doses globally, earning a staggering annual net profit of nearly 100 billion RMB, about $14 billion USD. Yet, just last month, after 6 years of suspension, Sinovac was officially delisted from the Nasdaq, concluding its reign in disgrace. But the most shocking twist came right before its exit. The company initiated a massive, almost $90 billion clearance-style dividend payout, resulting in an incredible dividend yield of 850%. How could an enterprise which had the potential to become a global pharmaceutical giant end up collapsing and draining its reserves in such a spectacular fashion? Part 1. The Peak and the Plunge. Sinovac's journey began in 2001. It quickly established itself as a key player through its rapid response during the SARS 2003 and H1N1 2009 outbreaks, eventually listing on the Nasdaq. The true highlight was between 2020 and 2021. Its vaccine, Coronavac, was listed for WHO emergency use and shipped to dozens of countries. In 2021 alone, Sinovac's profits surged by 3,694%, generating nearly $14 billion in net income. That's an average daily profit of $268 million. However, this pandemic-fueled super dividend failed to translate into long-term competitive advantage. As global immunity built up, orders plummeted, and by 2022, the company's revenue had crashed by 92%. On the surface, Sinovac was delisted for failing to submit its audited annual report, but the true cause was a decade of chronic corporate governance chaos. Part 2. The decade of infighting and the final payout. The system-wide breakdown was triggered by a fierce control struggle that erupted in 2016 between the founder and the major shareholder. This wasn't just a boardroom battle. The conflict escalated into extreme measures like seizing company seals, cutting production lines, and physically occupying factories. The fallout was immediate. In 2019, unable to form a functional board or provide reliable financial statements, the Nasdaq suspended its stock. The share price was frozen at $6.47, and over 99% of its market value vanished. Then came the astonishing final move. As the business was shrinking, Sinovac announced 3 rounds of massive dividends that could total up to $8.9 billion, or about 70% of its cash reserves. The market widely viewed this not as a return to shareholders, but as the controlling parties exploiting the final exit window to hollow out the company's cash pot. Part 3. A cautionary tale. Sinovac was a firm with significant assets, a mature vaccine platform, one of China's largest production bases, and a global distribution network. It had the foundation to become a world-class biopharma company. Yet this potential was demolished by governance failure and strategic short-sightedness, short-term vision. Despite earning billions, Sinovac's R&D expenditure in 2021 accounted for only 4.7% of its revenue, dramatically lower than the industry average of 15 to 20% for its international peers. The profit was distributed, not invested in the future. Broken structure. The board became a battleground, resulting in frequent executive turnover, while audit and compliance functions were non-existent. Ultimately, a culture where internal feuding took precedence over development eroded strategic focus and external trust. Sinovac's fate is a tragic reminder. When founders and capital players treat a company as a gambling chip, and when short-term gain trumps long-term value, collapse is inevitable. The king of vaccines is gone. It walked away with billions, leaving investors with nothing but a broken shell and a powerful commercial fable for the future of the biopharmaceutical industry.